Using multiple time frames. You may know that there are different time frames when looking at charts. You have the weekly chart, you have the daily chart, you have the 5-minute chart, you have the hourly chart, the 4-hour chart. It's important that all of these charts represent the same stock, but just a different amount of time. So for example, we are on the weekly chart time frame for Boeing, and each one of these candles represents 1 week worth of price action. If I were to change this time frame to the daily chart, it's still the same price action, it's still the same stock, but each candle now represents 1 day's worth of price action rather than 1 week's worth of price action. And if we move this to the 5-minute time frame, now it's the same stock, the same chart, but each candle represents 5 minutes worth of price action. So depending on what type of trader you are and what type of trades you are trying to take, you may want to conduct your analysis on a different time frame than what others conduct theirs on. So for example, me as a day trader, I'm not too concerned about what's happening on the weekly chart time frame because 1 week's worth of price action, that's a lot of price action to try to give me information for a day trade on a minute-to-minute basis. That's just not going to work for me. But if you are a swing trader or somebody that holds for a longer period of time, then the weekly time frame may be where you want to conduct your analysis. Put simply, the longer that you plan to hold your position for, the larger the time frame that you will want to use. The shorter amount of time that you're holding your position for, the smaller the time frame you're going to want to use. Me personally, I will almost always conduct my analysis on the daily chart time frame initially, just to get an overall view of what the stock is doing, and then I work my way down to the 5-minute time frame after finding setups that offer high probability on the daily time frame. What you may notice is that as you conduct your analysis on these larger time frames and then work your way down to the smaller time frames, those support and resistance lines that you draw on the larger time frames oftentimes will still be relevant on the smaller time frames. So for example, I'm on the chart here for Boeing, the daily chart time frame for Boeing, and I've drawn myself a resistance line up at $184 and a support line down here at $176. But if I move to the 5-minute time frame, you can see that that resistance line that I had drawn at 184 on the daily chart time frame is still relevant on the 5-minute time frame. We have resistance here, resistance here, resistance here, resistance here, and then eventually a break of that resistance there and the run higher. Essentially, what you're doing when you're looking at a stock on multiple time frames is something known as cross time frame analysis. Something else that you're going to want to take into consideration when looking at different time frames are your EMAs. So for me, the 200 EMA and the 50 EMA are the most relevant on the daily chart time frame and the weekly chart time frame. Why? Because they are larger EMAs. So let's think of what is a 200 EMA comprised of. Well, it's built off of 200 days worth of price action or data. Therefore, when I think about day trading and I'm day trading on a 5-minute time frame, is an EMA that is comprised of 200 days worth of data really relevant to a single 5-minute candle? Probably not. That's too much data and so little time. Those two usually don't mesh well together. However, if I'm looking at a whole week's worth of price action or a whole day's worth of price action, then all of a sudden, maybe 200 days worth of data is relevant, and it definitely is. The same is true for the 50 EMA. It is comprised of 50 days worth of data. It is relevant on the daily time frame. It is relevant on the weekly time frame. It is not so relevant on a 5-minute time frame. And the opposite is also true for your smaller indicators. If I move to the 5-minute time frame, my 9 EMA and my 21 EMA, which is comprised of 9 days worth of data and 21 days worth of data respectively, those are going to be a lot more relevant on the smaller time frames than they are on the daily time frame or the weekly time frame. I see a lot of day traders get this confused when we do analysis together. They say, Gates, the price action of the stock bounced off of the 200 EMA on the 5-minute time frame. And I say, whoa, hold on. I don't know of any strategies that utilize the 200 EMA on a 5-minute time frame. Is that data really relevant, or is it kind of just a coincidence? So if I were you, and this is the way that I work, I would not give too much weight to the 50 EMA and the 200 EMA on those smaller time frames, just because it's too much data in comparison to such little price action. And of course, the other indicator that we have here is VWAP with the upper band and the lower band. That is absolutely 100% strictly for day trading and should only be utilized on the smaller time frames. I also want to add this: when you are day trading, I primarily use the 5-minute time frame for confirmation, and if you are a brand new trader, I highly recommend that you just stick with the 5-minute time frame if you're looking to day trade. If you are more advanced, or if you get to a point where you start to get more experienced and advanced, then you can begin to look at smaller time frames than the 5-minute, such as the 2-minute or the 1-minute time frame, to pinpoint entries, but I would still utilize the 5-minute time frame for confirmation. The reason I recommend this is because 1 minute's worth of price action really isn't that significant, and there are a lot of fake outs that happen on the 1 minute time frame. So you may think that you're getting confirmation on a 1 minute time frame, when in reality that price action isn't that significant, doesn't hold a lot of weight, and could cause you to see something that's not actually happening. For example, if we're looking at the 5-minute time frame for Boeing, we can see here that this is a proper triangle pattern where you do have wicks to either side, but the bodies of these candles are still closing within the resistance and the support zone. But if we look at this same chart on the 1 minute time frame, now all of a sudden it looks like you're getting a breakdown down here, and it also looks like you're getting a breakout up here, when in reality the price action is still trading within this zone, but the 1 minute time frame kind of makes it look like the stock is moving up here and making a higher high, when in reality it's just rejecting. That's not as clear on the 1 minute time frame because these look like full-bodied candles, very strong candles, but when you look at the 5-minute time frame, you actually see that that's a topping wick candle, which is a rejection candle and not a breakout candle. Ultimately, whatever time frame that you decide to conduct your analysis on comes down to you and personal preference. Me personally, I just like to use the daily time frame for analysis, the 5-minute time frame for confirmation, and occasionally the 1 minute time frame to pinpoint my entries. Very rarely do I even look at the weekly time frame, the 4-hour chart, or the hourly chart, as those are just not that relevant to what I do as a trader. Whatever you do and whatever time frames you decide to use, I will recommend that you always start with a larger time frame and work your way down to a smaller time frame. This is going to allow you to get the overall picture of what a stock is doing first, and as you move down to the smaller time frames, allows you to be more exact with your trading plan as you dive further into the price action. As always, I hope that the videos helped you out and you were able to get some good notes from this, and I'll see you in the next one. Cheers.